away, somebody have to pay, right? And it will cost that much by the minimum. If somebody have Alzheimer, like my grandma have Alzheimer, average person who have Alzheimer will live about 7 to 10 years. Because why? They forget everything, they're happy every day. But the problem is, when they live that long, who's going to care for them? My grandma run away from home. I don't know where she went. So later on, we have to put her into nursing home, right? And that was like 20 plus years ago, it cost us almost $1,000 nursing home. But now, in Georgia, it will cost you about $5,000. In Florida, more expensive. Okay? So increasing costs can erode your purchasing power and your savings. And for us, regular investor, we save and we invest, right? And these are the return over the past 20 plus years. Average investor return is 2.1%, comparing to the rest of us. Okay? If you use the average over all these years. So we are not investing, we are not growing our money, and at the same time, the cost to live is getting higher and higher, right? So what is an annuity? One of the strategy is use pension to cover your retirement. And annuity is nothing new. Okay, annuity, a lot of you, how many of you have pension from the job? Pension is a form of annuity. And the biggest form of annuity in this world is what?
Social Security.
Social Security. Every month when you put a little money, you pay a little money into the Social Security bank, so-called a trust fund, they use it to buy annuity. So that when you turn 65, 67, the government, so-called the government, pay you, it's actually your money, right? Pay you the rest of your life. Okay, so that is annuity. So let me share with you what is annuity. This is probably the biggest pension in the world that we don't understand. A lot of us, we have no clue. So today I'm going to give you the 101 overview. Annuity is a hybrid. It's a combination of retirement, investment, and insurance. It's a hybrid product. In annuity, you can also add a guaranteed income, just like Social Security, right? They guarantee your income when you turn 65 the rest of your life. You can do that via Social Security, but it also is better off sometimes for you to do it privately, okay? Because you do privately, you don't have to share the burden among the big crowd, okay? So this is the main concept. There are 3 types of annuity. First is fixed. Fixed annuity, they pay you a fixed interest rate, okay? It's better than the bank. The bank, how much is the bank paying you now on CDs here? 0.07. And do you have to pay taxes? Yes. Right? So it's very little. Fixed annuity, generally they pay you between about 1.5 to 2% fixed now. So it's much higher than the bank. Okay? The second form of annuity is equity index annuity that ties into S&P 500, the equity index. The third form of annuity is variable. They go with the market, the mutual fund market up and down, up and down. Okay? So there are only 3 forms of annuity in the marketplace. Most of you who have Social Security and most of your company or your school pension is in fixed. Most of them in fixed. No risk, no market risk at all, but it doesn't grow a whole lot. But it's tax deferred. Okay? So what can be used in index annuity? Pretty much all kinds of plan out there, we can use index annuity. There are 3 kinds of plan. One is tax now, tax later, and tax advantage. Okay? The tax now product, checking account, mutual fund, stocks, investment property, etc. What is tax now product? Every year when you make money, you have to pay taxes first. Right? Let's say you make $100, right, this year. You pay taxes of your ordinary income. Let's say you are at 30% tax bracket. So you make $100, you pay $30 taxes, you're left with what? 70 to be reinvested to next year. So that is tax now product. Okay? So tax later is much better than this. Tax later we have SEP, simple. If you own your own business, you can do SEP IRAs. You can defer a much higher, up to $54,000 of your income a year if you own your own business. If you work in a job like a 401k, you can only defer up to $17,500. So they give a lot of advantage for entrepreneurs. So all these are tax later, which means right now whatever you contribute, you get a tax deduction, right? Let's say you make $50,000, you put $10,000 into this program, and how much taxes will you be paying? $40,000. Okay, so you get a tax deduction, and whatever that you earn here, do you have to pay taxes? Yes, in the future, but right now you don't. You grow tax deferred, then in the future, if you take it out before 59.5, they'll penalize you 10% and income tax. If you take it out after 59.5, you pay income tax on everything here. Okay, and if you hit 70.5, you don't withdraw anything, the government will penalize you 50% of the undistributed amount plus income tax. So somehow, some way, Uncle Sam will get their hands in your pocket here. But this is much better than here. At least you don't pay taxes every year here, okay? So this is the best tax advantage. How many of you heard of Roth IRA? So Roth, you pay taxes now, then in the future you don't have to worry about taxes. After 59.5, not a single penny taxes you have to pay. Roth 401k, okay? Also very powerful. After tax money, you put it in, grow, 59.5, you don't pay taxes, okay? And cash value life insurance policy, this is very powerful because this doesn't have the age limitations and the amount can be much, much bigger. So later on, we're gonna share more about this, okay? So, how does index annuity works, especially equity index, okay? Fixed annuity is very simple. This is equity index. This is S&P 500, go up and down, right? You see this orange line? Index annuity is when the market go down, you don't go down. You never lose money. When the market go up, you go up from the higher point instead of going up from the lower point. So when the market go up, you go up like this. When the market hit this point, instead of going down, you never lose money. Okay? And then when it go up, you go up from here. So you always outbid the market, especially there's a strategy inside that you don't to guarantee you no loss. Okay? So this is index annuity. So index annuity, there are different features. And most people, they never heard of this. For example, certain program, if you can do a longer term program, they give you an 8% bonus. Let's say, for example, you have a 5,000 IRA, right? Let's say, how old are you? Do you mind if I ask you?
45.
45. So you have a $5,000 IRA. You're 45 years old. You cannot take this money until 60 years old anyway. So you have 15 years, right? So I can do a 10-year program like this. So I put $5,000 in, they give you 8% bonus right away. So your account value will start with 5,000 and 8%, which is $540. $5,040, right? So you get 8% bonus.
5,400.
5,400. Okay. So your account value start with 5,400, and then you can run two strategies. They can guarantee you a 7% interest compound every year. And at the same time, you can also put it in S&P 500. You can run two strategies. See, these are the things that a lot of us never heard of, right? So today, I just wanted to give you an overview so that you know what is available out there, how the rich run these kind of strategies. Then that way you know what to do, right? And then, let's say you turn certain age, you can draw income, a percentage of your income for life. And if you need long-term care, they will double your payout on this. So there are a lot of different options that you can do, you know, in this kind of index strategies. But most of us, we only know one kind, which is the fixed, right? So this is generally how it works. I'm not going to go over the detail because I want to save some time for David, okay? So for example, you have $100,000, right? You're 45 years old, okay? You left your job. I have $100,000 in my old 401k, I don't know what to do with it. You can roll it into an IRA. Better to roll it out into your own IRA because why? What if the company go bankrupt? If you have a retirement plan with American Airlines a few years ago, right? What happened? When they go bankrupt, a lot of people 401k got affected because they have a lot of American Airlines stocks inside the 401k book. So when you leave your job, you need to roll it into your own individual retirement account. Then that way, whatever happened in the old company, you don't have to worry about it, including your pension. Right? If they allow you to roll it out. Some pension, they won't allow you to roll it out until you turn certain age. So let's say you roll out 100,000, right? You get 8% bonus, so your account value will start with 108,000. If the market crashed tomorrow, you will never lose this 108,000. Okay? And that is the feature of index annuity. Okay? So what happened? Then you can do it in different strategies. Let's say I put a 7% guarantee every year. There are strategies that I can put a 7% guarantee income every year and then it will compound every year. So in 10 years time, you have 212,000. 108 in 10 years guarantee at 7%, you have minimum 212. But at the same time, I also have the S&P 500. The S&P 500 might be below, underperform, or the S&P might be overperform. Okay? So you can choose at that time which one you wanted to pay.
So this is the minimum, you say?
This is the minimum, okay? So let's say 20 years. After 20 years, I get this 77% compound, my account value will be 424,000 minimum, guaranteed. Or the S&P can be higher than 420 something, maybe 500, I don't know, right? But at least no matter what happened to the market, I'm hedged, I'm protected. Minimum, I know how much I'm gonna have when I retire, okay? But there's a catch, Let's say this value, Can you take the whole value out when you retire?
No.
No, you cannot.
90%?
No.
Every year they allow you to draw 10%, no penalty. But if you want to take the full value, you can only take the full value of the S&P. Maybe higher, maybe lower. We don't know, right? We don't know what's going to happen 10, 20 years from now. But the S&P value, I can take it out, walk away anytime. But in this guaranteed value, you have to draw income for life. That is only, that's all. It can be a downside, it can be a positive. You know why? Because if I have a guaranteed income of this amount every year, if me and my wife join, I can take these two value, joint income the rest of my life. And if I need long-term care, they pay me double. At least I know in the future, I know how much money I'm going to get. Just like Social Security, right? At least I know how much I'm going to get in the future from this account, starting with 100,000 with my Social Security. Every month, if I know I'm going to get $5,000, $6,000 a month, then I don't have to worry about my retirement. Then the rest of my investment, I can do a little bit more risky investment. Does that make sense? Okay, so this is one of the strategies that you can do, and it's very dynamic. You can do whatever you want, but at least this is out there. Okay, so you can draw income the rest of your life. If you individually, you can minimum draw $23,000 a year income, or husband and wife can draw $34,000 income. Okay, imagine if this is not 100,000, if this is 200,000, 400,000. Imagine this value. Okay?
Yeah, but in some cases, Social Security income after retirement, it could be higher than this amount.
Of course, this is just supplement. This is just supplement. Okay, so lifetime income. So history of S&P 500. So this you can go online and find out what is the history of S&P 500. Most fund manager, 80% of their mutual funds invest in S&P 500. Okay, but the best part is on index annuity strategy. If the market go down, I will never lose money. So if the S&P go up, I'll go up. Okay, but you might not get all. Let's say S&P go up 10%, you might only get 7%. Because they guarantee you if the market go down, they guarantee you not losing money. And at the same time, you wanted to put in the rider, the guaranteed 7% every year rider. Yes, you can put that on, but there's a fee on that, about 1% fee. But you can run two strategies. I can run one S&P strategy, and I can also run a guaranteed strategy. If I want to do that way, then that way I'm hedged against everything, right? Maybe I put 1/3, let's say I'm 50 plus years old. I put 50% of my money into that kind of strategy. I know for sure I'm going to get 7%. Then the I know how much income I'm going to get in the future, right? Then the remaining 50%, I can do a little bit more risky investment, because if I can lose this 50%, I still have this 50% guarantee for life. A lot of the rich people, they know how to run this kind of strategy. But for a lot of us, probably this is the first time you heard of it, right? That's why this is the new industry that we are building. Education. There are information out there, it's just that we don't know, right? So this is S&P 500. It's a benchmark of US economy. You can read through this. We have that book. And tax deferred, the power of tax deferred, you know, on tax deferred account, tax now account. Okay, thank you, Andy. If somebody say $5,000, if they grow tax deferred in a 401k or IRA account, you have $2 million, $2.4 million at 8%. If you do tax now account, like you put in mutual funds, stocks, or banks, or what have you, right? Every year you have to pay taxes, half of it gone. The difference is 1.2 million. So it's very important to understand the importance of tax deferring. What if this is tax deferred, you still have to pay taxes in the future, right? But what if this is tax advantage that you don't have to pay taxes? And there are strategies out there that David is going to talk about. Okay, so I wanted to share with you, sometimes if you understand how to save on taxes, that is your return already. You don't have to do too crazy of an investment, right? If you learn how to save on taxes, that is your return already. Is that true? Right? So, final test on index annuity. Index annuity can give you a lifetime income. You can choose the lifetime income, or you can walk away the amount, up to you. CD, you cannot do that, right? And the interest rate is so low. Mutual fund, they cannot guarantee you lifetime income because market go up and down, right? Tax deferred, index annuity, yes. CD, no tax deferred. Mutual fund, no tax deferred. Every year you have to pay taxes.
CK, can you go back to another page, the previous page?
I tell you what, because we're running out of time, I want you to spend more time with David. All this information you can Google online, and I'll give it to you later, okay? Yeah, so principal preservations. If the market crash, that's the most important thing. When the market crash, and everybody know it will, we just don't know when, right? So if the market crash, this index annuity, guarantee your principal? Yes, because you never lose money. CDs, you never lose money either.